If you own gold or silver, you need to pause everything you are doing right now. What I am about to share with you is not noise, not hype, and definitely not something you will hear on mainstream financial television. A massive shift is forming under the surface of the precious metals market, and most people have absolutely no idea it is happening. This is one of those moments where being early matters more than being right later. Francis Hunt recently dropped a warning that sent shockwaves through serious metal investors. According to him, the gold to silver ratio is standing on the edge of a collapse that almost nobody is prepared for. We are talking about a move so violent that it could push the ratio into single digits, and when that happens, silver does not slowly grind higher. It explodes. Think about that for a second. For decades, silver has been treated like the forgotten metal. Cheap, abundant, easy to replace. But Hunt argues that this illusion is about to shatter. In old money terms, he says silver is not stopping at a few $100s, not 300, not 500. He is openly talking about 4-digit silver, numbers that sound insane today but could feel obvious tomorrow. Now here's the part that should make you uneasy. Most of the world's silver is not mined on purpose. Roughly 60 to 70% of global silver production comes as a byproduct from mining other metals like copper, zinc, and lead. That means silver supply does not respond to price. Even if silver triples, miners do not suddenly flood the market with more metal. At the same time, demand is quietly preparing to go vertical. New technologies, especially next-generation solid-state batteries, could consume the entire annual silver supply on their own. That would leave nothing for solar panels, nothing for electronics, nothing for industry, and nothing left for investors like you and me. The supply crisis has already started. Most people just do not realize it yet. Before we go any deeper, let me frame this conversation properly. This channel exists for people who worked hard their entire lives and refuse to let a broken system erase their purchasing power. If you're watching this and you're over 50, you already know something feels off. Prices rise faster than savings. Promises feel hollow, and the rules keep changing. That is exactly why this discussion matters right now. Francis Hunt is not guessing. He's reading the same signals he has watched for decades. Sitting in front of his charts, he noticed something alarming. The gold to silver ratio, the number that tells us how many ounces of silver it takes to buy 1 ounce of gold, has entered what he calls the contagion phase. That is the moment when a distorted system starts correcting faster than anyone expects. For years, this ratio was pushed higher and higher. Silver was kept artificially cheap, while gold carried the spotlight. At one point, the ratio reached 126, a level that makes no historical sense. Then something snapped. The ratio broke below the critical level of 65, and that move was not random. It confirmed a massive macro reversal pattern that Hunt has been tracking patiently. He explains it calmly, but the implication is explosive. When long-term ratios break like this, they do not gently drift lower. They collapse. The technical structure alone suggests a move toward 32, but Hunt believes that is just the beginning. He expects the ratio to eventually fall into single digits, something most analysts would call impossible. Now do the math with me. If gold is trading around $3,000 an ounce and the ratio drops to 9, silver suddenly prices above $300 per ounce. And that is still conservative compared to what Hunt believes comes next, because markets do not stop at logical targets when fear and momentum take control. They overshoot, violently. Francis Hunt makes one thing very clear. Late-stage bull markets never behave politely. They do not stop at reasonable levels, and they do not give everyone time to think. They run far beyond logic, far beyond comfort, and far beyond what most people believe is possible. That is how extreme wealth transfers are created. Not through calm appreciation, but through emotional overreaction. He explains that when markets enter this phase, prices overshoot in the opposite direction of suppression. For years, silver was treated as worthless industrial scrap. When the narrative flips, it does not flip gently. All of a sudden, everyone decides silver is real money again, and the reaction becomes excessive. That is when prices stop being rational and start becoming historic. This is not theory. Hunt has studied every major silver bull market in modern history. They all end the same way. Not with balance, but with parabolic blow-offs. Prices surge vertically, volume explodes, and disbelief turns into desperation. Those who held through the noise see generational gains. Those who hesitated watch it happen without them. But here is where most investors fail. They sell too early. Hunt introduces what he calls the law of the parabola. In exponential moves, the majority of profits are made at the very end. The final 5 to 10% of the move delivers roughly half of all gains. That last stretch is where patience pays off and fear destroys results. Most people will panic long before that point. Silver hits 100. They sell. It reaches 150. They regret selling. It touches 200. They convince themselves it must crash. And while they celebrate small wins, silver keeps running without them. Hunt is not warning people to gamble. He is warning them not to underestimate how violent this move could become. Most silver investors do not lose money because they are wrong. They lose money because they exit too early. Francis Hunt understands this psychological trap better than most. He explains that when prices start moving fast, fear replaces logic. Every pullback feels like the top. Every red candle feels like confirmation that the move is over. But in parabolic markets, pullbacks are not warnings. They are resets. They are the market catching its breath before the next surge higher. Those who do not understand this mistake, volatility for danger and safety for stagnation. Hunt introduces a concept that separates professionals from spectators. He calls it the discipline of staying inside the parabola. In this phase, price action becomes emotionally violent. Headlines scream bubble. Friends tell you to take profits. Family members beg you to lock in gains. And yet, statistically, this is the moment when holding becomes more valuable than timing. Hunt explains that selling too early is far more common than holding too long, because fear arrives before exhaustion does. He shows exponential charts where silver appears to move slowly for years, then suddenly accelerates almost vertically. That final acceleration looks unsustainable, but it is where the math changes. Hunt reminds investors that half of the total profit in these moves comes from the very last stretch. Miss that final window, and you miss the wealth transfer entirely. That is why he trains his audience to expect chaos rather than clarity near the top. At this stage, Hunt says something unsettling. He admits that when silver reaches these levels, price stops being the real story. Currency itself becomes questionable. He openly wonders what money will even mean when silver reaches extreme valuations. Whether it is a paper dollar, a digital system, or something else entirely, he does not pretend to know. His point is clear. Silver is not just rising in price, it is exposing weakness in the monetary structure beneath it. This is where the conversation shifts from investing to survival of purchasing power. Hunt is not promising comfort. He is warning about instability. Silver does not reach extreme valuations because everything is going well. It reaches them because something fundamental is breaking. And those holding physical metal are not speculating. They are positioning themselves on the right side of a system under stress. At some point, every investor asks the same question, and Hunt hears it constantly. Is it already too late to buy silver? It sounds reasonable on the surface, but Hunt dismantles it with a single line of logic. If an asset is moving toward 1,200 in old money terms, does paying 80 or 90 really matter? That question silences the room because suddenly the fear of missing out is replaced by the fear of missing the entire move. Most people anchor to today's price instead of tomorrow's reality. They obsess over small pullbacks and wait endlessly for a perfect entry that never arrives. Hunt sees this as paralysis disguised as discipline. In fast-moving bull markets, the biggest mistake is waiting for certainty. Certainty only appears after the move is over. By then, opportunity has already passed to those willing to act, while doubt was still present. Another concern Hunt addresses is what he calls the entry point paradox. On long time frames, silver looks like it is already running. Monthly charts show no clear dips, no obvious support zones, just a relentless climb. To inexperienced investors, this feels untradeable. To professionals, it is an invitation to zoom in and hunt for opportunity inside the chaos rather than avoiding it. Hunt explains that markets move in layers. While the macro trend screams higher, micro time frames constantly offer pullbacks. Daily charts, 4-hour charts, even hourly charts. Inside those smaller windows, price breathes. It hesitates. It pulls back just enough to scare weak hands and reward prepared ones. These moments are not accidents. They are how markets transfer positions from fear to confidence. This is where strategy replaces emotion. Hunt is not telling people to buy blindly at any price. He is teaching them to align with the dominant trend while managing risk intelligently. Tight stop losses, defined entries, and most importantly, the patience to stay engaged instead of waiting on the sidelines while the move continues without them. To prove his point, Hunt pulls up live charts using the same platform where his own capital is deployed. This is not theory or hindsight analysis. These are real positions, real entries, and real risk management decisions. He shows silver, gold, and even Bitcoin moving higher while the majority of commentators were calling for tops. The disconnect between public opinion and price action could not be clearer. Hunt highlights specific moments where silver dipped briefly inside the broader uptrend. Small pullbacks that looked insignificant to most people, but offered precise re-entry opportunities for those watching the right time frames. He explains how these dips are not signs of weakness, but structural pauses, moments where the market releases pressure before resuming its climb. He points out 2 such entries and explains how stop losses were placed just below relative lows. The risk was defined. The reward was asymmetric. If price failed, losses would be small. If price continued, gains would compound rapidly. This approach removes emotion from decision-making and replaces it with structure and probability. The results speak for themselves. Those entries are now deeply profitable. One position showing gains above 150%. another exceeding 300%, and the trend remains intact. Hunt stresses that this is not luck. It is the outcome of understanding how volatility behaves inside powerful macro cycles. Most traders never experience this because they fear volatility instead of studying it, and they see movement as danger rather than opportunity. Hunt teaches the opposite. Volatility creates access. Every pullback is a door briefly opening. Those who hesitate watch it close. Those prepared step through while others freeze. Hunt then zooms out and does what very few analysts bother to do. He abandons short-term noise and pulls up a quarterly chart that stretches back to the 1950s, more than 70 years of price data compressed into a single structure. What emerges is not a normal cycle, but an extreme compression pattern, what he describes as a squeeze inside another squeeze. The longer an asset is compressed, the more violent the release tends to be once the structure finally breaks. This kind of formation does not appear by accident. It is the result of decades of accumulated distortions, indirect intervention, paper inventories, and a narrative carefully built to keep silver undervalued. Hunt explains that compressions of this magnitude rarely resolve slowly. When they break, they do not form trends. They create structural displacement. Price does not climb step by step. It jumps levels. The initial breakout occurred with minimal risk and a clearly defined technical target above $300. But Hunt makes it clear that this number is not the top. It is a resting zone, a place where weak hands exit and strong hands accumulate before the next expansion. This distinction is critical, because many investors mistake consolidation for reversal and exit precisely when the structure is being reinforced. The logic behind this is simple and unforgiving. Markets do not reward urgency or consensus. They reward correct positioning inside structures that most people cannot see. By the time everyone believes the story, the move has already happened. Hunt insists that real wealth is created while the thesis still feels uncomfortable, exaggerated, or even absurd to the average observer. This is where his philosophy becomes most uncomfortable. He does not see markets as battlefields, but as systems that constantly offer opportunity to those who learn to observe without emotion. Most investors, he argues, walk over value without recognizing it. They confuse noise with information and movement with risk. The market does not punish ignorance. It simply transfers capital to those who can recognize structure where others see chaos. Hunt then exposes the flaw that sits at the core of the silver market and explains why most analysts completely miss it. The gold to silver ratio stayed artificially high for far too long, not because silver was abundant, but because the market created the illusion of abundance. On paper, inventories appeared large. In reality, much of that silver was not accessible, not mobile, and not truly available. If you do not control it physically within your own borders, Hunt argues, you do not actually have it. He traces this distortion back to decades of financialization when paper claims replaced physical ownership. Silver became something that could be leased, rehypothecated, and counted multiple times across balance sheets. This worked only as long as demand remained manageable. But once physical demand rises beyond a certain threshold, paper structures fail. The illusion of supply collapses the moment delivery matters more than price discovery. What makes the situation truly dangerous is how silver is produced. Hunt emphasizes that roughly 60 to 70% of global silver supply is mined as a byproduct of other metals. That means silver production is not driven by silver demand. It is driven by copper, zinc, lead, and gold economics. When silver prices rise, supply does not respond in any meaningful way. The miners are not there for the silver. It is incidental to their operation. This creates a structural trap. Demand can explode while supply remains fixed. Even extreme price increases fail to unlock meaningful new production. Opening a primary silver mine takes years, enormous capital, regulatory approval, and energy input. For decades, silver prices were too low to justify that investment. The result is a market with almost no elasticity on the supply side at precisely the moment demand is accelerating. Hunt is clear that this is not a normal bull market dynamic. This is a rationing event. When supply cannot respond, price becomes the only mechanism left to balance demand. Silver does not rise because it is popular. It rises because it becomes scarce. And once scarcity replaces availability, price discovery turns violent, fast, and unforgiving for anyone who is not already positioned. Hunt then shifts from charts to technology, and this is where the narrative turns from bullish to existential. He explains that the world is being pushed toward an electrified, digitized infrastructure where silver is not optional. Electric vehicles, smart grids, surveillance systems, medical equipment, defense technology, and renewable energy all rely on silver's unmatched conductivity. There is no substitute that performs at the same level without massive efficiency losses. Silver is embedded deep inside the modern economy, invisible but essential. The real shock comes when Hunt explains the impact of next-generation solid-state batteries. These are not incremental improvements. They are transformational. Batteries capable of powering vehicles for hundreds of kilometers with rapid recharge times change transportation, logistics, and energy storage permanently. But this technology has a critical constraint. It consumes vast quantities of silver, not marginally more, orders of magnitude more than current systems. Hunt delivers the numbers slowly so the audience understands the implication. If even a fraction of these advanced batteries reaches mass adoption, they would consume the entirety of current global silver production, 100%. That leaves no metal for solar panels, no silver paste for electronics, no supply for medical devices, and nothing left for investment demand. The industrial system alone would absorb everything available. This is where the equation breaks completely. Demand is no longer competing within a balanced system. It overwhelms it. Solar installations are already expanding at record speed, each panel requiring silver for electrical flow. Consumer electronics continue to multiply. Defense systems consume silver aggressively and without price sensitivity. These sectors do not slow down because silver becomes expensive. They secure supply at any cost. At this stage, Hunt is no longer talking about price targets. He is talking about allocation failure. When multiple essential industries depend on the same constrained input, the market does not negotiate. It rations through price spikes, shortages, and forced prioritization. Silver stops being a commodity and becomes a strategic resource. And once that transition occurs, the concept of fair value disappears entirely. At this point, Hunt confronts the most dangerous question in the entire silver cycle. When do you sell? Most investors obsess over entry prices, but exits determine outcomes. Hunt is blunt. Price levels mean nothing by themselves. Round numbers like 100, 300, or 500 are emotional traps. The real signal, he argues, is the same metric that warned of the coming move in the first place, the gold to silver ratio. When that ratio collapses into single digits, the final phase begins. This is where discipline separates fortunes from regret. Hunt reminds investors of the law of the parabola once again, because it is here that most people fail. By the time silver reaches extreme valuations, fear becomes overwhelming. Media narratives turn hysterical. Friends accuse you of greed. Pullbacks feel violent and convincing. Yet, statistically, those pullbacks occur inside the final acceleration phase, not at the top. Selling everything too early destroys the asymmetric payoff the entire cycle was designed to deliver. Hunt explains the professional approach: partial exits, not emotional liquidation, reducing exposure enough to remove psychological pressure while allowing the core position to run. The structure protects capital while preserving upside. Amateurs look for certainty and end up selling at the worst moment. Professionals accept discomfort and manage risk without abandoning the trend. The market does not reward comfort. It rewards controlled exposure to uncertainty. Then Hunt says something deeply unsettling. At those levels, he admits, he does not know what money will even represent anymore. Whether it is a paper dollar, a digital system, or something entirely new, he cannot say. His implication is clear: silver reaching extreme valuations is not a sign of prosperity. It is a signal that the existing monetary structure has failed to contain its own contradictions. This is why Hunt rejects the idea of neat endings. Silver will not top gracefully. It will spike, pull back sharply, spike again, and then reverse faster than most expect. The final phase will be chaotic, emotional, and unforgiving. Those who waited for clarity will miss it. Those who prepared mentally for disorder will navigate it. The move has already begun. The only remaining question is whether you are positioned for the full cycle or watching history repeat without you. Hunt closes the loop by returning to the long-term structure, reminding investors that this move did not appear overnight. It was built quietly over decades of suppression, mispricing, and false abundance. The quarterly chart stretching back more than 70 years shows compression so extreme that resolution was inevitable. When energy builds for that long, release is never subtle. It is sudden, disproportionate, and emotionally destabilizing for anyone unprepared. He emphasizes that silver's final phase is rarely orderly. History shows that the metal does not peak with balance or logic. It peaks with excess, confusion, and violent reversals that punish hesitation. Prices overshoot fair value, then collapse rapidly once demand is exhausted. That is why Hunt stresses that exits must be planned before euphoria takes control. Decisions made in advance outperform decisions made in panic. This is also where most investors rewrite history in their own minds. They tell themselves they knew it would happen. They say the signs were obvious. But knowing and acting are not the same. Hunt warns that regret is not caused by lack of information. It is caused by lack of conviction. The market offers clarity early and chaos late. Those who wait for clarity usually enter during chaos and exit during fear. Hunt's final lesson is not about silver alone. It is about how wealth moves during systemic stress. Assets that were ignored become essential. Narratives flip without warning. Liquidity disappears when it is needed most. In these moments, positioning matters more than intelligence. Preparation matters more than prediction. and patience matters more than speed. He leaves investors with a quiet warning. This cycle is not finished, not this month, and likely not this year. The forces driving silver are structural, not speculative. Supply is constrained, demand is accelerating, monetary confidence is eroding. The train has already left the station. The only remaining question is whether you're on board, holding through volatility, or standing on the platform, watching generational wealth move out of reach. From this point forward, the market enters what Hunt would describe as the transition window. This is the most deceptive part of the entire cycle. Prices continue to rise, headlines grow louder, but conviction remains fragile. Volatility increases, not because the trend is failing, but because capital is repositioning. Weak hands rotate out on every pullback, while stronger hands absorb supply quietly. This phase is uncomfortable because it feels unstable, yet structurally, it is where the foundation for the final move is built. During this window, false signals multiply. Analysts begin calling tops prematurely. Short sellers grow bolder. Media narratives oscillate between enthusiasm and fear. Hunt warns that this confusion is not accidental. Markets shake confidence before they reward patience. The goal is not to convince everyone, but to exhaust those without a plan. Historically, many investors exit here believing they escape just in time, only to watch the market resume higher without them. What defines this phase is not price, but behavior. Silver has not yet entered mass obsession. Retail participation remains uneven. Institutional allocation is still cautious, fragmented, and largely indirect. Physical premiums begin rising faster than spot prices, signaling tightening availability beneath the surface. This divergence between paper price and physical reality is a hallmark of an approaching structural break. Hunt emphasizes that once this divergence widens, the market changes character. Liquidity thins, delivery timelines stretch, confidence in paper substitutes erodes. At that point, price no longer invites debate. It enforces decisions. Those without exposure scramble for access. Those overexposed panic. And those positioned early shift from accumulation to defense, managing exposure rather than chasing upside. This is why Hunt insists that preparation must occur before urgency. Once the final acceleration begins, there is no time to think. There is only reaction. The work of understanding structure, psychology, and exit discipline must already be done. Markets do not announce their climax. They reveal it only after it has passed. To finalize, Hunt leaves no ambiguity about what this cycle represents. This is not a normal commodity rally, and it is not driven by speculation alone. It is the result of long-term structural pressure finally breaking through layers of distortion. Decades of suppressed pricing, paper substitution, and misunderstood supply dynamics have reached their limit. The system held as long as confidence remained intact. That confidence is now eroding. Silver's move is not happening in isolation. It is unfolding alongside rising geopolitical stress, fiscal instability, and declining trust in monetary stewardship. When multiple pressures converge, markets do not adjust smoothly, they reprice violently. Silver is simply one of the first assets where the imbalance becomes impossible to ignore because its supply is rigid, its demand is essential, and its substitutes are inadequate. According to Hunt's framework, the most important work for investors is already done before the final surge begins. Understanding the structure, accepting volatility, defining exits based on ratios rather than emotions. Those who wait for confirmation will arrive too late. Those who prepared early will spend the final phase managing exposure instead of chasing it. This is not a call for panic or euphoria. It is a call for awareness. Cycles like this do not repeat often, and when they do, they reshape capital distribution for a generation. Silver does not need belief to move higher. It needs scarcity, and scarcity is already present beneath the surface. Where this ends will only be obvious in hindsight. But where we are now is clear. The transition has begun. The structure is broken. The pressure is building. And history shows that when silver finally finishes a cycle like this, it does not do so quietly. If you made it this far, that already says a lot about you. Very few people have the patience, focus, and intellectual discipline to follow an analysis like this all the way through. That alone puts you ahead of the majority, not by luck, but by long-term thinking and clarity. Thank you for being here, for thinking beyond surface-level narratives, and for being part of the Asian finance community. Subscribe to the channel, hit the like button, and share this video with someone who values depth over noise. And if you want to take the next step in this reflection, watch the video that is appearing on your screen right now.